Hello, and welcome back to my channel. Today we will focus in my session on the angle of the institutional investor, the LP, the limited partner. What I mean by that are family offices, pension plans, endowment funds, as well as sovereign wealth funds and the larger entities. The question that I always receive is, or often receive, or what I often notice, is that quite a few LPs are not aware of the opportunities that the secondary markets offer. And admittedly, 10, 15 years ago, the secondary market was very small, very illiquid, and did not offer the opportunities that it does nowadays. But I strongly believe that any LP not taking advantage of what's going on in secondaries is not looking at all the opportunities on the table if and when running a diversified private capital portfolio within the larger picture of its total AUM. So let's start off with an introduction into the secondary markets. And again, I will be very firmly wearing my LP hat and will be asking questions around the reason or the benefits that secondary markets offer for LPs. Let me add as well that a few weeks ago I did a webinar with two senior executives from Coller Capital out of London, both INSEAD alumni, and I will share the link to that fireside chat in the chat below. So please do click it and explore it further, because it was quite an interesting conversation where a lot of interesting questions were asked and addressed. Now, as you will have seen in my earlier channels, private equity, the whole private capital space, is one of the largest, of the fastest growing asset classes that we've seen in the last 20 years. So 10.5 times the asset class, including anything from distressed, private equity, venture capital, obviously real estate, infrastructure, natural resources. A 10.5x growth is pretty unique in the financial market. Now, even when you look at private capital versus public markets, so the value of PE companies has grown more than 8-fold since 2000 in the last 2 decades, by far outpacing public market equities. Now, private equity is usually known as an illiquid asset class. So one wonders, with so much money flowing into the industry, has that changed in the last 2 decades? And the answer to that is clearly yes. And one of the answers is the secondary markets. Now, what drives secondary market growth? So clearly, primary markets growing leads to a greater demand for secondaries as well. And clearly that's, if the primary markets stop growing, I would argue the secondary markets will do the same. But what are secondaries? So the private equity secondary market is the resale market for investors' interests in funds and direct investments. So what does it mean? That means secondary transactions are one way for LPs, for institutional investors, to exit early from their investments in primary private equity and venture capital funds. That obviously gives them access to liquidity. When we have a look here at the growth in the primary private equity fund, you can see the secondary market is growing and not quite catching up with the primary funds. To some extent, why? Because we've seen such a fast growth in primary funds. Nevertheless, we can say nowadays that even for private equity funds and emerging markets, there's a reasonable possibility that one can see liquidity in the secondary market space. So secondary transactions give investors a chance to exit from their allocations to private equity and venture capital funds, thereby adding liquidity to a usually known as illiquid asset class, i.e. private equity and venture capital. Now, what role should secondaries play in an investor's portfolio? So like we just said, secondaries allow LPs to exit early from their investments in primary funds. That means they do not have to stay until the 10 or 12 years down the road when the fund is ultimately liquidated. This gives basically the investors a great opportunity to shape their portfolio. Now you may say, how liquid are those secondary markets? And we can safely say very liquid nowadays. Now, that means basically it gives investors the opportunity to, number one, diversify their portfolio. So for example, backfill, acquire access to a vintage of a primary fund that they may not have had an opportunity to access at the time. So if I sit today in 2020 and I would like to add a 2015 vintage to my venture capital exposure, I can do so by trying to acquire, if available, a slice of a 2015 venture capital fund. That, on the other hand, gives other LPs that may have invested in the primary fund in 2015 the opportunity to step out in year 5, thereby giving them access to liquidity. It allows me also to rebalance my portfolio. I may want to reduce my allocation to large US buyout funds and increase my allocation to European mid-market buyout funds. So that would basically be possible in a secondary transaction. It also allows me to modify my exposure due to regulatory changes. We saw that in 2012 to 2015 when, due to Dodd-Frank, a lot of the banks decided to step out of their activity in private equity and spin out their exposure. And obviously, locking in returns, taking profits is always appreciated by LPs, and the secondary markets gives them the opportunity as soon as a fund basically arrives in a profitable area. Now, what does it also mean? It means it mitigates the J-curve effect. We spoke about it in my earlier sessions on the introduction to private equity. And you see here the J-curve of a primary fund from year 1 to year 12. So if I would invest here during fundraising in year 0, I will have to go through this investment phase where the J-curve is negative, i.e. I have more capital outflow than I have any returns. Now, secondary funds usually focus on the realization phase when they are investing. Thereby, the LPs investing in secondary funds avoid that negative phase on the J-curve. Again, very attractive, pending what kind of investor I am, pending what expectations I have with regards to the investments in my private capital portfolio. This could be very attractive. Now, just a brief overview of the types of secondary transactions. So far, I've spoken to kind of the traditional LP secondaries, where basically here's my private equity fund, the GP running it, that fund is invested, let's say, in 10 or 15 portfolio companies. An investor 2 in year 5, for example, would like to achieve an exit. So this investor 2 will look for a buyer in the secondary market and thereby step out of its responsibilities as an LP in the private equity fund. The buyer then steps into the shoes of investor 2. This can only be done with approval, with the agreement of the GP. So those transactions are called traditional or LP secondaries. We also have what we call direct or synthetic secondaries, where, let's say, for example, as I mentioned in 2012, quite a few banks who until then were active in private equity and ran their own investment portfolios decided, due to regulatory changes, to sell their portfolio companies. So a transfer of assets off the balance sheet of the bank to another buyer was desired. So the secondary buyers may then basically raise a new fund. They may actually take some of the professionals that were employed by the bank and take them out and spin the whole portfolio, all the assets out into a new fund. That new fund is then being given a new GP, which may be the original team that worked for the bank beforehand. And this new fund is then being funded by the secondaries. Now, you may wonder, what does pricing look like? So you're saying that I can sell my LP stake in this fund, but how does the pricing history look like? So let me show you here the last from 2007 onwards, because it gives us an opportunity to look at what happened during the global financial crisis in 2008. And what you see here is the average secondary price as percent of NAV, percent of net asset value. So as you can see during, and we have different ones here, buyouts, real estate, venture capital, and the all PE is the purple curve. So here we can see that in 2008, the pricing, some of those assets in good funds you were able to acquire those at a substantial discount, up to 30-40% discount to net asset value. As you can see in the last few years, obviously, those discounts are gone. We've actually seen some transaction happening at a premium to net asset value. So if an attractive asset comes to market in the secondary space, this is very much possible. But this gives you a sense, so very clearly, during crisis or post-crisis, you will see that some of those assets trade at a discount. We will have to see what that meant in 2020 when we see the data in early 21. Now, what's the risk profile of secondaries versus primary funds? That's usually the question that I receive from new LPs, large investors that are for the first time allocating to private equity. And as you can see here, secondaries have a pretty decent median net IRR, a median net return, with a reasonably low risk profile. So as you can imagine, venture capital, for example, has a very high standard deviation, a very high volatility in terms of, as we know, investing in venture capital, I did another session on that, is risky and it requires a high level of diversification. So that gives you a sense that secondaries deliver a very nice return with a very, very low risk profile. Now, for those investors with a low risk capacity, this is actually usually one of the main reasons why they start allocating to secondaries as they start building their exposure to the private capital space. Let's have a look basically as the portion of funds with a net multiple of less than 1x. What does it mean? That means the portion of funds with a net multiple of less than money invested. So basically what I'm asking here, what is the proportion in those various buckets of funds that do not return the capital invested? Obviously interesting for investors. So as you can see, secondary funds are by far the fewest secondary funds return a loss. Clearly, venture capital, as we know, statistically, a significant amount of venture funds never return the money invested. So, and this basically goes down as we go towards more diversified vehicles. So that basically is some food for thought for some of the investors out there. Again, it speaks towards the kind of risk capacity and risk appetite you need to have to invest in those funds. So I will stop here. There's obviously more to be said. And as I said, if you want to follow the half an hour conversation that we had with Coller Capital out of London, please check below. I will put the link in the box. But what we addressed today was, number one, a comparison of primary versus secondary funds. We looked at the types of secondary transactions and discussed a little bit the risk profile of secondary funds in comparison to other private equity vehicles. And obviously, the whole session was run very much from the perspective of the investor. I look forward to seeing you in one of my other sessions where we will again focus on the questions that I often get from institutional investors in the private asset class. Thanks for listening. Please subscribe if you like the channel.